Hey there, Investorholics. Welcome to the ETF Spotlight Review. Today we'll be taking a closer look at NDIA, which is the Global X India Nifty 50 ETF. So this one invests in 50 of the largest companies in India. If you have an interest in emerging markets and your investment time frame is sort of medium to long term, this might be of interest, but as always with these type of investments, you have to be happy with sort of a high to very high risk return profile, I suppose, is the best way to describe it. And a lot of these things, you're going to have your money in the market for a good few years. Like I say, it's a sort of a longer term investment. So if you're looking for some upside in emerging markets, my feeling is India is a place to definitely be keeping an eye on. It's already had quite a lot of growth, but I think there's still a bit of growth ahead of it. So stick around and just soak up the information. Hey there, Investorholics. It's Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content. You can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your financial life, expand your investment horizon, and crack your financial sky. Don't be afraid to give us a thumbs up and a subscribe. Okay, so the NDIA seeks to provide investment results that correspond generally to the price and yield performance before fees of the NSE Nifty 50 index. So the NSE is the National Stock Exchange of India. The NSE Nifty 50 index is a flagship index of the National Stock Exchange of India, as I mentioned. It's designed to track the performance of the blue chip Indian companies. The index covers 50 of the largest and most liquid Indian domiciled securities listed on the NSE and is weighted by float adjusted market capitalization. As always, we need a why. Looking for growth, obviously, if you're looking in emerging markets. Rebounding from the pandemic, India's GDP is forecast to grow at a rate of 7.4% in 2022 this year. So looking for targeted exposure, well, that's what we'll get. So the fund targets exposure in a single country, i.e. India. Efficient access, so NDIA offers access to 50 of the largest and most liquid companies traded in India. So that covers quite a few different sectors as well. So it's not just in banks or whatever. Although, as we'll see later, there is quite a few banks in the top 10 anyway. Okay, so we had a net asset value of $63.04, trading above that at $63.20. Pretty small ETF, this one. You're looking at just a bit over $30 million. Management cost 0.69%. You get one dividend a year, and at the moment the dividend is about 4.69%, so just over 4.5%. The total market capitalization of the NSE Nifty 50 index is $2.43 billion, so almost $2.5 trillion. When you think about it, this is more than the S&P 200 combined in just the top 50 companies in India. So it's, you expect such a large country to have quite a large index. So the NSE has more than 1,600 listed companies in total. India is predicted to have a GDP of over $9 trillion by 2030. And it's expected to be the largest country by 2050, and that overtaking the US. So you probably have China and India as being the two largest economies. So while it's been forecast that the next 12 to 14 months will be challenging for India as the country recovers from the effects of COVID-19, the long-term forecast predicts that there will be, will become the second largest country by GDP, as I kind of mentioned before. So the ETF could potentially be used as a satellite position to expose the investments portfolio to ongoing growth in India, and as sort of a catch-all, you can use that as just your emerging markets exposure if you're looking for emerging markets exposure. As I always say, we need to make sure we're doing our research, so have a look at IIND, which is a beta shares version of the Nifty 50 ETF, so have a look at that one. Okay, so performance since inception has been pretty good, 9.32%, although having said that, that is a little bit different to the actual return of the benchmark. So you're looking at 12.28%, and that's sort of, almost 3% below. So the return of the fund's 3% below the return of the index. And, there's obviously a bit of a tracking area, but you also got to factor in the fees. So higher fees, higher impact on your overall investment. And in the last 3 years anyway, you've done almost 11%. In the last month, you've done 8.25, which is pretty handy. Top 10 companies here. I mean, I must confess I don't really know many of these. Obviously, we know Tata. Tata is quite a big group. But the other ones here, like Reliance, as I sort of said before, there's quite a few banks in this list. So HDFC Bank, ICICI Bank. There's like a housing development fund and a few other different things here that I'm not too familiar with. So if I was going to buy this one, that's kind of what I'd do. I'd go back and have a look at familiarise myself with these companies anyway, and what they do, especially the top 10, because they will actually make up a majority of the investment in the fund. So what I find interesting too, something sort of reason why this sort of piqued my interest, is the number of US dollar millionaires in India is expected to more than double by the year of in 3 or 4 years. So according to Credit Suisse, the wealth per adult in India has risen to an impressive average at an impressive average rate of 8.8%. To the year 2020, and stood at a bit over 15 grand, so $15,535 at the end of 2021, which is it's actually, I suppose it's risen quite a lot, but when you look at it globally, it's actually it's actually a lot below the global average, the global mean, I should say. So actually last year, the mean wealth in India, average mean wealth, fell by 41% worldwide. But I think, as India grows, industrializes, and starts to bring their sort of lower, less affluent population up into the middle class, what you're going to see India start to grow quite rapidly. With India, there's different challenges. As with every country, there's a lot of different challenges. Infrastructure is a big thing in India, so I think if they can start to work on the infrastructure and education and things like that, I think it'll definitely make a big difference. But I think you sort of start to see a lot of millionaires and a lot of billionaires start to pop up. I think that's the time you need to take notice, because these markets are starting to grow, and if we can put a small investment in, I think we'll get a reasonable return over the next 5 to 10 years. So in my feeling is this one's worth a look. But as always, you need to actually really dig into it a bit. Emerging markets can always be quite risky. So do your research, have some fun, might be something you buy just as a small portion of your portfolio. Anyway, hopefully that was interesting. Just something as a side, something different to look at. Emerging markets are always, as I said, a little bit risky, but I think worth the time and effort over the long run. Get into them while the more developed markets are on the up. So have a look at these things when they're sort of in the doldrums a bit, to sort of have some counter-cyclical aspects to your portfolio. Thanks, guys. Hopefully you enjoyed. Ciao. Hey there, are you interested in learning more about personal finance and investing in the markets? If you are, smash the like and subscribe buttons down the bottom of the screen there. Crack the sky. Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your financial horizon and crack your financial sky. Hey guys, I hope you enjoyed the video. Please give me a like and subscribe. Greatly appreciated. Thank you.